Well, it was a sketchy start to the month of July, but last week the market struck back. Hi everyone, welcome to the Traders Circle weekly market update. Today is Tuesday the 18th of July, and before I get into it, you do need to be aware that anything I say is general advice only, so it doesn't consider your personal financial circumstances, and you have to decide if what I'm saying is appropriate for you. Peak rates, that's the talk around town. It's the talk from the US. They had a much lower than expected CPI reading a fortnight ago. Headline CPI at 3%, core CPI at 4.8%, and it does go to show that the interest rate rises the Federal Reserve has been conducting has gone some way to reducing inflation. In fact, it's getting back towards more normal levels. Now, this has got markets excited, it's got stock markets excited, it's got bond markets excited, and really we've seen some strong rallies based on the view that we're not going to see too many more US rate rises. So the odds are on one more rate rise coming next Wednesday at the July meeting from the Fed. But most people are now believing that this will be the last rate rise this cycle. It'll be an interesting thing to see whether that's the case, but it shows that the Federal Reserve is perhaps at the moment winning the battle against inflation. Now, our own market, the Australian market, has rallied on the back of this. It's followed everyone else higher. And our own bond yields came off as well on the back of this read. The one thing I would say though is we're not the US. Their lower inflation is not our lower inflation. In fact, our inflation is more than double US inflation, more than double the RBA's target range. And so it's all well and good that our market's getting excited about the prospect of peak rates, but that's a US peak in rates. It's not necessarily an Australian peak in rates. And given that our inflation is still very high, our unemployment's still very low, and our interest rates relatively low compared to the US, compared to Europe, compared to Canada and New Zealand. I think our market's definitely getting far ahead of itself, in forecasting our own rate peak. Now, we did see the RBA statement on monetary policy today. They did say that they'd look at more rate rises, and to be honest, I think it's very hard to forecast an Australian interest rate peak here, because we haven't really seen a significant and rapid dent in inflation. We'll get some more inflation data next week. Unfortunately, that'll be after my video next week, but even that data is expected to still remain very, very strong, and it's hard to argue against further rate rises in the current inflationary environment in Australia. So our market rallying on peak rate hopes, but the Australian interest rate peak perhaps nowhere in sight. Now, obviously no one likes rate rises, but I just think that's the state of play at the moment, given that we don't want to see a prolonged period of high inflation in Australia. We don't want to see a prolonged period of very high interest rates. I think best to just try and get on top of it, and I'm not sure the RBA has been doing that. So that leaves us with the RBA, and we've seen a new governor announced. So Philip Lowe, his term will end and he'll step down, and Michelle Bullock, current deputy governor, will become the new head of the RBA. New governor. Obviously, this is a interesting move, and a lot of people have said, well, Philip Lowe's been too hawkish. He's gone too hard on rates, and I completely disagree with that. And I'd also caution against assuming that Ms. Bullock will be any more dovish. She's already a board member of the RBA. Most of the existing board will stay on for several years more. I think there's about 9 members of the board, and at least 7 of them will stay on past the current year. And it's the board that decides rates. It's not Philip Lowe, and him being removed doesn't necessarily mean that anything will be done particularly differently at the RBA. And I would like to say that, where he has been criticized for lifting rates and being hawkish in the news media, compared to these international peers, you could very much argue they haven't gone hard enough. New Zealand has got higher rates, the UK has higher rates, Canada, the US have higher rates. A lot of them are showing signs of getting on top of their inflation problems, yet we remain a fair bit lower than these equivalent economies, and our inflation remains a lot higher than many of them. So they're getting towards the end of their battles, and we're sort of in the middle of our battles, I would say. And so hopefully we do see some new action from the RBA, but I'm not sure it's going to be dovishness anytime soon. Now, like I said just before, I think our market has overpriced the hope of peak rates. And any sort of additional Australian data could be a potential catalyst for a bit of selling in our market as we sort of start to forecast more interest rate rises. So this week you've got unemployment, next week you've got CPI. They're both going to be major releases for this, and there could be major potential catalysts for movement in our market. The other major thing to remark on this week is US earnings. It started on Friday with a few major banks and United Health as well, and it'll continue in earnest tonight and for the rest of the next fortnight. Earnings started pretty well on Friday. United Health had a fantastic result, jumped very strongly on the back of that. A lot of the big banks reported fairly well, but a lot of them didn't rise on the back of those earnings reports, even though they were above expectations. So there's a few things to talk about here. In the US, about 3/4 of reporting companies generally beat expectations. Historically, this was probably a tactic by the companies and their analysts to encourage buying, but I think that the average investor has definitely wisened up to this fact. So a beat on expectations is no longer enough to send a share price higher in the US. The other thing is that US shares are extremely expensive at the moment. There's obviously been a big rally in US shares, around 20% off their March lows, and that looks, the share price look historically expensive, but also on a price to earnings basis, they're historically expensive. Earnings per share over the current prices, you're seeing around 20 times current earnings for US shares. This would be a pretty expensive historical average for shares, but it's also expensive when you consider just how high the risk-free rate is. US interest rates up above 5%, and you've also got US price to earnings up above 20 times. So earnings look very expensive historically, and they look very expensive compared to the risk-free rate compared to the returns on bonds, for example. So this will have to be a fantastic earnings season, an exceptional season, I think, for US shares to continue higher at their current rate of growth. Otherwise, if it's if it's an average season or even just a good season, we may see some selling creep into some of the large cap US shares. So let's have a look at the charts this week. This is our XJO, and you can see over the past week it's rallied very strongly, jumping about 300 points from roughly 7,000 to roughly 7,300. We did stall out around 7,300, and we sort of drifted a little bit sideways, a little bit lower for the past couple of sessions. There is also a potential longer-term uptrend line coming in around the current peak. It won't really be confirmed unless we see some selling from here, and there hasn't been a huge commitment to the selling for the past couple of sessions. We've sort of drifted sideways to lower, and any weakness has been bought back up. I do think there's a risk that a bit of reality will set in if a bit more Australian data comes out, but last week was a bit void of data, and this week we're not going to see anything until the unemployment read. At the moment, we're holding that 7,300 as resistance. The stochastic is looking a bit toppy. If you're going to do a directional bearish trade, you're probably waiting for that nice clear bearish bar entry signal, something like these days here. Otherwise, if you see a break through that trend line, a break through 7,300, maybe a close around 7,320, you're looking for a move towards 7,370, the previous peak, the peak before that, and roughly the peak before that one as well. If we do fall from here, expect to see some maybe some support around these moving averages, roughly 7,200, but really the key supports are around 7,080 and 7,000 index points. Looking across to the US, we can see the stellar run they've been on. Like I said, roughly 20% for the S&P 500 since the March lows, and they've even accelerated above that initial trend lines. They're probably sitting on an accelerated trend up here. Let's see if we can draw that one in. Something like that. And breaking several key resistance levels. It's hard to say where the next resistance would be for their market. I mean, it has been an absolutely mammoth run. You do have to go all the way back to roughly April, May last year to find equivalent levels. And, around those times you'd say maybe around 45, 50, but perhaps even all the way up to 4,600 as the next potential resistance. Like I said though, it's going to be quite hard for US shares to keep going because they're very, very expensive relative to earnings. So will the earnings season push them that little bit further, get them back to that 4,600 key level, or will it bring a bit of reality to their market as well and perhaps bring them back to the trend lines? They do have a much more optimistic situation in the form of, their interest rate peak perhaps approaching, but, that can't sustain price movement forever. Should they fall from here, looking for a move back to the previous resistance, which may now act as support, roughly 4450 index points, and then if that breaks, back to the longer term uptrend. Alright guys, that's it for this week. We've seen optimism in markets around the world. Is that optimism starting to fade, or will it continue? We'll have to find out in the next session. Hopefully you guys enjoyed. If you did, click subscribe, and I'll see you in the next one. Bye for now.